Ed Yardeni is president at Yardeni Research. He's joining us now to take some questions. Ed, good to have you with us here. Should this pass, first of all, do you think, there'll be any problem in getting this through the U.S. Congress, one? And if it were to be the case, will it spark a risk-on rally, or it'll all be priced in by the time we get to it?
All great questions. Look, I think that a deal is going to get passed by Congress. I never anticipated that we'd have a problem. I thought it would be a last-minute kind of situation, which is what it was. I think the stock market really hasn't been all that worried about it, quite honestly. I mean, look, the market's been actually going up pretty nicely in the past few weeks, and notwithstanding concerns that there could be a terrible default crisis, which is not going to happen, and I never thought would happen. So I don't know that there could be like for, a morning kind of trade situation, a move to the upside, but I think a lot of the good news was already anticipated by the markets. The markets have seen this play before, and it's turning out to work out the way it has in the past.
Ed, hi, good morning. Given everything, the Indian markets have really, rallied quite a bit. In fact, this year now we're hardly 2% away from all-time highs yet again. We also have some big cues coming up. Of course, there's the rate cycle, but apart from that, we are heading into an election year in 2024, and generally when that happens, markets sort of, see a lot of the gains being priced in 6 months in advance, whether it's in infrastructure, capital goods, etc. How are you feeling about India now, and what is your prognosis?
Well, when I look around the world, India still looks as though it has a lot going for it. The Chinese economy isn't doing as well as people had been anticipating coming out of the lockdowns that they had imposed on their people. There was an anticipation that there would be a lot of pent-up demand. And yet what we're seeing is the price of copper, which is very sensitive to developments in China, remains weak. I think the property market remains in trouble over there. Meanwhile, the Cold War, hot war situation between the West and China, between the West and Russia, these Cold Wars have been pretty hot. They've been extremely hot, of course, in the Ukraine, which is a proxy war really between the West and Russia. And so from that perspective, there's a lot of pressure to put supply chains in areas of the world that are viewed as relatively stable and secure. And India certainly stands out in that regard. So the geopolitical situation is favoring India with regards to foreign investors. And I don't mean just foreign investors into the stock market. I mean direct investments, companies actually investing in India.
All right. Good morning, Mr. Yardeni. The other point is everyone was looking forward to this debt ceiling deal being reached. And as you said, maybe a majority of the good news is in the price. But the problem, I think, for equity markets is from not anticipating any rate hike or considering it as a distinct possibility, now there's a high probability that we get another rate hike coming from the Fed. What's your sense? We get the rate hike and then they pause?
I think you're right. I mean, now that the debt ceiling issue is very likely to be behind us, assuming that Congress passes it this week, we'll move on to other things to worry about, and the Fed will be back in focus. The markets, I think, are discounting a 25 basis point increase in the Fed funds rate sometime over the next two meetings. I think the Fed will pass on raising the Fed funds rate at the next meeting. They could very well do it at the following meeting, but it's my view that the Fed is done. I think inflation is continuing to moderate. I think that the U.S. economy is growing, but at a slow pace. The big issue is the banking crisis. We've been very lucky that the banking crisis hasn't become an economy-wide credit crunch and a recession. And I don't think the Fed wants to really push the limits of what the financial markets can withstand in terms of high interest rates. I mean, we are in restrictive territory with regards to the Fed funds rate, as evidenced by the banking crisis. So I haven't given up on the notion that the Fed's going to pause for a while, for a long while perhaps, and that we may not get further rate increases this year.
Okay. And you've kind of held that view for a while that, they're looking at backward sort of data and for all practical purposes, they should be done. Whether they're actually done or not, we'll see. But a pause is coming. But in any case, we will. It's also your view that we will hold on to these, 5, 5.25, 5.5 kind of levels of the Fed funds for some time, Ed. I mean, maybe.
I think so.
Yeah.
Yeah, I think the Fed in the past, interest rates went up and then they came down pretty quickly. This time around, I think the Fed is trying to find a level that's restrictive enough without causing a recession to bring inflation down. And I think they're at that point right now. I hope they don't get impatient. They've said that they want to get to their 2% inflation target, not by this year, not by next year, but by 2025. And I think they're exactly on the right course for that. And I think the stock market has rallied on the perception that we're not going to have a recession after all, and that technological innovations could be a very important stimulus to the U.S. economy.
Okay, all right, Ed, we leave it at that. Thanks a lot for stopping by and speaking to us at CNBC TV 18. Of course, for our own markets, the bulls have come back in a big way. We are at the cusp of new highs. So looks like today could be that day. Whether we hold on to that, of course, time will tell. But for now, the optimism is real and the momentum has been intact. So let's